Let me ask you something. Have you ever been stopped out of a great trade only to sit there and watch it just take off without you? Man, it is one of the most frustrating things in trading, right? Well, today we're going to talk about how to fix that. We're going to break down a really simple but powerful strategy to set a smarter stop loss using a tool that's probably already sitting on your charts.
You know, every single trader, and I mean every trader, knows this feeling. You've done the research, you found a perfect setup, you're in the trade, and then that little voice starts creeping in. Where on earth do I put my stop loss, right? You put it too close, and you risk getting shaken out by some meaningless market noise. But you put it too far away, and you're staring down the barrel of a devastating loss. It's a tough spot. So what's the real nightmare scenario for you? I mean, what's the one that really gets you? Is it setting that stop loss super tight, only to watch the price dip down, tag you out by just a few cents, and then blast off into orbit without you? Ugh. Or is it setting it way too wide, to give it room to breathe, and then just watching a tiny, manageable loss spiral into something truly painful? This is the tightrope we all walk, and it's the exact dilemma we're going to solve today.
So, what's the answer? Well, it's not some super complex secret indicator you have to pay for. It's a tool that's probably already on your charts right now, the simple moving average. And we're going to use this tool to create a stop loss that's not just a guess. It's logical, it's objective, and best of all, it's dynamic. So what even is a moving average? Honestly, think of it like smoothing out a really bumpy road. It takes the average price over a certain number of periods, say 20 days, and it plots that average as a single flowing line. Its whole job is to just iron out all those little insignificant price jitters, all that market noise, so you can clearly see the real direction of the underlying trend.
Now, you'll see that most traders kind of flock to a few key MAs. If you're a short-term trader trying to catch those quick moves, the 20-period MA is usually your go-to. If you're more of a swing trader holding for a few days or weeks, that 50-period MA gives you a much better picture of the medium-term trend. And then you have the 200-period. That's the heavyweight champion, the one that many traders use to define the entire market trend. Are we in a bull market or a bear market?
Okay, now this is where it all clicks. This is the key idea that is going to fundamentally change how you think about your stop loss. We need to stop seeing the moving average as just some wiggly line on a chart and start seeing it for what it really is in an uptrend, a dynamic support zone. And that word dynamic is everything. See, unlike a static support line that you just draw on your chart and it stays there, the moving average moves with the price. It's market psychology in action. Think about it. These averages represent a consensus of value. So when the price pulls back to a key MA in an uptrend, all the traders who miss the first move up see it as a second chance, a fair price to jump in. That buying pressure creates support. It's like a rising safety net that follows the price up. And in a healthy, strong uptrend, you'll see this happen over and over again. The price will run up, pull back, touch or get close to that MA line, and then just bounce right off of it and continue its climb. That bounce is the market giving you a huge visual confirmation that, yep, the buyers are still in control and this trend is alive and well. All right, so we've got our tool, the moving average, and we understand the principle behind it, this idea of dynamic support. Now, let's get practical. Let's put it all together into a simple 3-step strategy that you can use on your very next trade. It's really just a simple 3-step process. First, and this is absolutely non-negotiable, you have to be in a clear uptrend where the price is consistently holding above your chosen MA. Second, you pick the MA that fits your trading style, short-term, mid-term, whatever it is. And third, you place your stop-loss order just a little bit below that line. You want to give the price a little room to wobble without breaking that critical support. And here is the truly beautiful part. You don't just set it and forget it. As the trend keeps going and that MA line slowly ticks higher and higher, you manually adjust your stop-loss up with it. Now, this does 2 incredible things for you. 1, it protects your initial capital, and 2, it actively locks in your profits as the trade moves in your favor. This takes so much of the guesswork and emotion out of it. You're no longer just hoping for the best. You're systematically protecting your gains.
But wait, this strategy isn't just about playing defense. It's not just about protecting your downside. It's also an incredibly powerful early warning system. It gives you a crystal clear signal that the trend you're riding might just be running out of steam.
Just look at this comparison right here. On the left, you've got that healthy trend we've been talking about. The price is respecting the MA, it's bouncing off it like a floor. But look at the right. That's the warning sign. The price doesn't just touch the MA, it slices right through it and, this is the critical part, it closes below it. That represents a fundamental shift in the market's behavior. And that close below the MA? That's your exit signal. That's it. It's the market telling you loud and clear that the dynamic support has failed. The buyers who are pushing this thing higher have lost control. The trend could be weakening or even reversing. Following this rule takes the emotion out of the decision. It forces you to protect your capital based on what the price is actually doing, not what you hope it will do.
So there you have it, a simple, objective way to manage your risk that gets you out when a trend breaks down and helps you lock in those hard-earned profits when it runs. The next time you're about to enter a trade, just ask yourself, am I just randomly guessing where to put my stop? Or am I using a dynamic, data-driven approach based on what the market is actually telling me? It's the difference between gambling and trading with a plan.